So loan limit increases in 2026 have gone even higher on conventional conforming loan limits.
About that, yeah.
Yeah, and it's like where do they stop? But
you want to talk about that?
Yeah, I mean, well, so most people think that interest rates are like the key to whether they can buy at a certain price point.
Yeah.
But now that loan limits have increased, it fits more buyers into that conforming bucket, allowing them to get more financing on larger purchase prices at better interest rates.
Yeah. So here's what I'll say. When I was a younger loan officer, I was really starting to hit my stride in around 2010. Okay. Back then, Huntington Beach, Southern California marketplace, you could buy a single family home for around $500,000.
Yeah.
Today, that same home is worth about $1.4 million. And we're talking 1,300 square foot, 3-bedroom, 2-bath, fixer-upper. All right, everybody. Well, we're back, and it's 2026. We're coming back. Happy New Year, everyone. We're going to be jumping in with one of our best loan officers, Ashley Griffin, who works out of the Ventura County Marketplace.
Hello.
22-year veteran. Am I getting that right?
24.
24. Oh, I'm 22. You're 20. You have me beat. So
I feel really old when I say that, too.
Hey, it's called wisdom and sage advice. How do we educate people through life experience? And life experience only comes with age.
Yep.
So the point is, you're combined talking about 46 years of mortgage experience.
Crazy.
We have a lot of nuanced knowledge, stuff that you would not find interesting, but what we are going to talk about today are interesting things. So what I understand, we're going to jump right in, is you have 6 things we're going to rapid fire today for realtors and buyers and even sellers' ears.
Yep.
I'm going to respond to the first one. What are we kicking it off with today?
So loan limit increases in 2026 have gone even higher on conventional conforming loan limits.
About that, yeah.
Yeah, and it's like where do they stop? But
you want to talk about that?
Yeah, I mean, well, so most people think that interest rates are like the key to whether they can buy at a certain price point.
Yeah.
But now that loan limits have increased, it fits more buyers into that conforming bucket, allowing them to get more financing on larger purchase prices at better interest rates.
Yeah. So here's what I'll say. When I was a younger loan officer, I was really starting to hit my stride in around 2010. Okay. Back then, Huntington Beach, Southern California marketplace, you could buy a single family home for around $500,000.
Yeah.
Today, that same home is worth about $1.4 million. And we're talking 1,300 square foot, 3-bedroom, 2-bath, fixer-upper.
Right.
Right? It's
That's
insane.
Crazy.
So what Fannie and Freddie have been doing is playing catch-up all these years.
Yeah.
We're finally starting to get to realistic numbers. What's the conforming versus high balance number?
Oh my gosh.
It's like 832 and
it changes
1.25 million.
So like Ventura,
every county is different. Ventura is different from Orange.
Yeah.
Yeah, because you guys are a little lower.
Right. And now like LA County and Ventura County are teetering about 1.1 to 1.2 is high balance conforming.
Yeah.
But it's and some change because they always like to make the number super strange.
Well, here's why it's important though. So what does a realtor or a buyer need to hear? Why is this important? Well, with Fannie, Freddie conventional financing, especially in that higher loan amount space, 1.1 to 1.2 million loan amounts, Fannie, guess what? This is what they've decided. You don't have to have reserves potentially, right? Primary residence. Now, if you walk into your local credit union and try to get a jumbo portfolio loan, you need 12 months plus of reserves.
Right. Exactly.
So where Fannie, Freddie come in and why it's meaningful every year that they're raising their loan limits is the barrier to entry for your average home buyer, especially first-time home buyers, is much lower with Fannie because you don't have to come up with a boatload of money.
Right.
You could do 5% down.
Right.
You can have zero reserves.
Right.
They're looking at what? They're looking at income and your ability to repay as the main foundation of whether or not they're going to lend you the money.
Right. And unlike most big banks, JMJ has access to home equity lines of credit.
That too.
So you can combine a home equity line of credit with
80-10-10, the old 80-10-10.
Right. Exactly. So that's pretty,
eliminating mortgage insurance being the stigmatized dirty word in our industry. It's not all bad, but I know people like to avoid it.
Right.
All right.
Exactly.
What would you say is next? I like this. Rapid fire.
Yeah, topic 2 is why appraisals feel different in 2026. So what we've experienced is that not every loan requires an appraisal. And that is key, because if we've got a quick escrow or we know that, and we've got a well-qualified buyer with, money down and, good credit, strong reserves, a loan these days may qualify with just an automated appraisal. And so speeding up the timing.
What you're talking about here is what? Conventional Fannie Freddie financing again. Guess who will require an appraisal? Your local credit union, a jumbo loan, a bank. Because they're going to be more uptight. They're lending their depositors money. It's called portfolio banking. Again, what was the first point? We're talking about increased loan limits for Fannie Freddie, Freddie Mac. They're the ones that also do what's called a PIW, property inspection waiver. And they analyze the file with their automated underwriting, DU, desktop underwriting, and they determine through their algorithm whether or not they think you need an appraisal or if they're just going to let you pass because they agree with what the value is. So you're noticing a theme here for you buyers out there, Fannie Freddie, path of least resistance.
Exactly. And so,
anything else you want to share on the appraisal front?
I just think it's really important for agents to set expectations with lenders in terms of quick contingencies. Talk to lenders. Talk to your lender before walking into an escrow and making an offer with your buyer. Do you need an appraisal? Is it strategic to maybe do a 5-day appraisal contingency or a 10-day appraisal contingency?
Well, we want to increase the chances of their offer getting accepted. And so we reduce the resistance points. And one of those is removing the contingency for appraisal if it makes sense to do so. And if not removing it, shorten it down.
Totally.
What's next?
Topic 3 is the rise of smarter non-QM lending. So for agents, deals fell apart when it was assumed that a buyer didn't qualify.
So your biggest referral source is
non-QM.
Or
why real estate agents.
It's from loan officers who work for banks.
That too.
They're dealing with their uptight underwriting guidelines, their old school underwriting guidelines. It's a bank. Right? It's a credit union. Where she's referencing non-QM, all that means is Alt A. Right? So you got A paper. You got what's the rung below that? Alt A. So you're self-employed. You don't show income on paper. But you have $2 million in revenue. In the old days, after the subprime crisis after 2008, guess what? That person was not getting what? A loan. There was nothing there for them other than maybe hard money. Now we have Alt A, where they submit their business bank statements, add up their revenue, apply an expense factor of roughly 50%. We use that as income. That's a big deal.
And I would say the majority of what we've done together and the majority of what I did last year, just
a lot of non-QM.
Tons. Non-QM. Majority of what I did could not be done in a bank. So it's not...
rates are actually getting more and more attractive,
That's true. If not more attractive than even the full doc stuff. We've even seen
DSCR, right? So you got we talked about bank statement, self-employed, rental income, right? Before it was show me your tax returns, and that was it. Now it's like we don't even need to see your tax returns. We look at the cash flow of the property. What's DSCR, debt service coverage ratio? It's actually how commercial properties are qualified. We're just translating it over now to residential. A lot easier. Again, bank statement loans for self-employed, DSCR for rental. Much easier than it used to be. And with Fannie Freddie, they don't want to do rental properties. And they show that with their price. Low-level price adjustments. We do have risk priced in with DSCR non-QM, but generally speaking, if the ducks line up in the right way, it's much better price.
That's so true. And I've looked at a few of those recently, and borrowers are shocked because we can do so many different creative loan structures within the non-QM world.
And we don't have to torture them. With paperwork.
So the takeaway is non-QM is not risky, it's strategic. And so I think that when you're looking at a self-employed borrower that may have just started a business and has tons of revenue, is successful on year one, has a ton of expenses to write off on year one, that borrower probably qualifies. So there are certain borrowers that, the banking world doesn't want to qualify right now.
No one's getting these loans at banks or credit unions. The other piece is a lot of people, we'll move on to the next topic after this comment, a lot of people have to do a 1031 exchange. And guess what? they don't have income on paper. Maybe they did at one point when they got the property in the first place, but they retired or their business isn't doing what it used to on paper. Well, guess what? Now 1031, I don't have income on paper. I got to go buy another rental.
Yep.
CR.
Yep. Totally.
What's next?
So this kind of falls in line with non-QM and creative lending, but interest rates compliance and creative financing is back. And so that creativity in the way that the deal is structured with respect to, maybe buy downs or like discount points, paying discount points, or seller credits are back, in seller concessions, maybe agent concessions, and so.
You're talking about being creative in the lending space to get deals done.
Right, exactly. Yeah. And so it's strategy-based lending, I feel like. Yeah. We've done a few deals. Almost every deal I've looked at in the last year has had a concession of some kind. And so that helps to offset closing costs for a borrower that, may be a little bit tight on liquid. Right?
Yeah. Or you need to get the debt-to-income ratio to a certain level from a qualification standpoint. So what I'll say to that is if you're going on bankrate.com and you're selecting your average random person in an average random state sitting in a call center to decide whether or not you get financing, probably not the best strategy. Right. So there's a saying in our industry, loans are hard on a good day. Okay? So you have in one category, which I just described, you have box checkers, right?
Yep.
That's it.
Yep.
And they quote and they're like, here's your rate and let's hope it works out.
Yeah.
Right? Salespeople.
Yep. Right.
Then here you go. Exhibit A, Ashley.
Yeah.
A stands for Ashley. You haven't, and advisor. AA.
True.
Actually. True. Yes, we're both sober, so this all works.
It's true. It does. It's all aligned.
You have your box checkers, but then you've got your advisors.
Yeah.
And I've seen her perform in the middle of a very complicated escrow period where you're just like, wow, that's what a real loan officer does. They bring value to figure out, not like, oh my gosh, the deal's not working. It's like, no, well, we just have to restructure. Let's get creative.
Yeah.
And that has to do with maybe buy downs, lender credits, seller credits, right? There's a lot that goes into this stuff.
Yes.
And JMJ Financial, the philosophy of JMJ Financial is we are about what? We are about closing loans.
Yes.
Right? You can work with a lot of underwriting departments and a lot of banks, a lot of loan officers, where it's almost like they're trying to find ways not to do the financing, right?
Totally. I agree.
Yeah.
I think that I've always felt that it's all about how can we get this loan done versus how can we say no to it going in. So I definitely think that we can get creative. Strategy is best when it's planned out, like you just said. I think that if you go into a call center, nothing is planned. You call, they do their quick pre-approval. There is no planning. So we do need to talk early. That's the key point. Talk early if there is a shortage in the file with respect to reserves or debt to income has to be lower. We should be reacting on day one, not day one of escrow, but day one of pre-approval, right?
Okay, so let's just spend one more minute on that.
Yeah.
Because you just hit the nail on the head.
Yeah.
This is the problem in our industry is people are in a constant state of reactivity rather than getting ahead of it. There's an old saying, an ounce of prevention is worth a pound of cure.
Yeah.
And that's all this is. Like if you want a good lending partner and you're able to follow their lead, they will tell you, let me talk to your client before you get in the car.
Yeah.
Right? And sure, realtors, do you need to hop in the car sometimes to get interest going? I understand. But on and beyond that, they have to talk to Ashley. We have to do a legitimate pre-approval, and then we're confident not just with the buyer's ability to make the payment. They need to be comfortable too.
Yep.
They need to be confident. So when they're making an offer, they're like, I got this.
Yeah.
Right?
Yep. Totally. Yeah. It goes into our next topic, which is what agents are still getting wrong about lending in 2026.
That happens.
And one of the biggest deal killers isn't the buyer or the seller. It's the misunderstanding in the lending space, right? And so
You mean realtors try to be loan officers?
Yes. Yeah. And also just, I think, not understanding the pre-approval process and how important that is and to start it early as possible, not call the lender the night you want to make the offer, right? I've had that happen. I recently had that happen where
I hope people are listening.
Right? Where we got a call at 5:00 I have a buyer that wants to make an offer on a $2.3 million home.
Yeah.
And it was a non-QM loan, and he needed the equity from his departure.
Yeah.
And it was going to be 2 loans in one, and I needed pre-approval to make an offer tonight.
My stress levels are rising.
Those
just
stress
hearing about
levels
it.
are rising. And the next day, he was in escrow. Do we have a fully pre-approved loan?
No, we have a ready, fire, aim situation where everyone's now in fight or flight.
Yes.
Right? The old term, chicken with your head cut off.
Yeah.
Running around.
Yep.
That's not what we want.
No.
That is a way of doing life.
Yeah.
Is that the advisable way of doing life? No. So,
Yep. So I really do think that agents need to understand the difference between a fully pre-approved buyer and somebody who is really just shy of pre-qualified, right?
Yeah.
Because, because there's a huge difference between looking at a deal and really looking at the income, looking at credit, looking at their income, their asset structure, and just pulling a credit report.
Yeah. So here's the power of a boutique direct lender like J&J Financial. We genuinely underwrite before anything happens, right? So we take their application, we run their credit. Don't worry, we could do soft pulls to avoid hard inquiries.
Yes.
Not going to hurt your credit. You're submitting your income documents. You're submitting your asset documents. You're submitting it all.
Yeah.
Our ops manager is dialing it all in, making it look polished and pretty. We're having income calculated and verified by underwriting.
Yeah.
And then we're like, you can go make an offer based upon these parameters because of what we found.
Yeah.
And that piece, in my opinion, J&J Direct Lender, I have Tony Kuda, you have Tony Kuda, our underwriting team, looking at it for us. I'm sorry, brokers, but if you're working with a broker, a lot of times you're like, hey, can you call this underwriter in Michigan and see if he agrees with us?
Yeah.
Not fun, right?
Not at all.
I've experienced that in the broker world. I was a broker for 12 years. It's a way to do it. It can get done. The broker space has improved. I'm not denying that.
Yep.
But I like my little comfort zone of having one of the most talented underwriters in the industry tell me, Jason, we're okay.
Yeah.
Yeah, that's it.
I appreciate that too. Risk management has gotten a little bit tighter, I feel like, within banks.
Yeah.
I noticed that
Wells Fargo doesn't even want to do loans anymore.
Do you know the banks right now have a 0% tolerance on exceptions?
Yeah.
And so it's pretty clear that all the big banks want to do right now is the vanilla, straightforward loan.
Totally.
And so there is so much more emphasis, I think, in the market on, in the direct lender space and also in the broker space because we can do the loans that banks don't want to do right now.
Yeah.
But with that said, too, we're not just doing loans without compliance and without paying attention to risk tolerance.
We just have more product.
Exactly.
Yeah.
And we know how to get around certain there's a little bit more lenience in our world, right? So we can make exceptions where banks can't.
Totally.
And we can mitigate for the exceptions. So it's not like we're just making a ton of risky loans.
Yeah.
We're mitigating risk really well.
Yeah.
And I feel like there was once a time where during the crash where every borrower wanted to go to a big bank because they felt more secure with a big bank lending.
This was right after the 2008 financial crisis, and understandably so.
Right.
And this is why you were working for Wells Fargo at the time.
100%.
Wells Fargo was the pinnacle of what was best practices, an example of best practices, somebody doing it in excellence. From basically 2008 to, let's call it 2020, like before COVID hit, let's call it that, to give them some credit, where credit's due. Once COVID hit, everything changed.
Yeah.
Are we out of our 6 topics?
No, I think we have. Actually, we do. I think that the wrap up, I have a little wrap up. I think that lending hasn't gotten harder in 2026. It's gotten more precise. And so I think that we have to, both on the buyer side, the seller side, the real estate agent side, and the lender side, we all have to work together, I think, more so this year than
collaborative.
We did, yes, in 2025. It's going to be more of a...
This isn't the game of the biggest ego wins.
Not at all.
This is the game of collaboration and professionalism wins and being precise.
Yeah. 100%.
Right, well said.
Yeah.
I guess we're okay. Let me just wrap up on one topic, and then we'll wrap it up. You real estate agents, you do want to hear this, okay? Bonus depreciation. We want to talk about that.
Yes.
Yes. I think so, and what's changed is when you buy a rental property, and by the way, my disclaimer is contact your CPA and get the legitimate certified public accountant's opinion.
Yeah.
But this is new. Bonus depreciation, whether you're buying a new vehicle that's over 6,000 pounds gross vehicle weight for your business. So you have S-Corps. Or you're a realtor with an S-Corp, and most of your waking hours as a professional is doing real estate-related activities.
Yeah.
When you buy a rental property, you can front-load what used to take 27 and a half years to spread out.
Longer, depending on the property. Sometimes even like 39 years for
commercial. Right. So that has changed, and, if you had a big income year, and you're trying to figure out how to reduce your tax liability, we're oversimplifying this on purpose. We're just trying to plant the seed so you can be like, oh, I got to call my CPA. Maybe I should buy more property, rental property, cash-producing property, investment property. Those are the properties that you can buy, front-load depreciation, and reduce your tax bill if you had a really good income year. I just wanted to make sure realtors were reminded of that because that is a significant piece of news.
Yeah, it is. And it's been reduced. So the IRS has reduced the amount that you can front load every single year.
It's not carte blanche.
It's not, right. But where there are sometimes, because not everything depreciates over 30 years. Flooring doesn't depreciate over 30 years.
Yeah.
So there's certain things like that. And so when you go to your CPA and you do a study, you ask them for a study that to depreciate all of the asset and the details within the asset. Sometimes what you think is not a good investment in the way that maybe it doesn't cash flow positive every month. Sometimes at the end of the year, at the end of the tax year, based on this accelerated depreciation, bonus depreciation, an investment property becomes even more affordable.
Yeah.
So you have to look at the big
picture. You're just looking at it at face value and not doing the hard work behind the scenes. Advisors like us and CPAs, you might be making a misinformed choice.
Right.
Yeah.
Totally.
All right. The last thing I would say in wrap up is at this time last year, the average 30-year fixed was 7%.
Yeah.
Right? This is the first time since basically late 2021 where we can finally say we're starting the year off on a much better foot.
Totally.
Okay. 6.15 is the Freddie Mac national average for a 30-year fixed.
Yep.
Last year it was 7%. Now, word of warning to buyers and realtors, if you're asleep at the wheel right now, waiting for spring and summer to start looking at properties, while, of course, you can do whatever you want. That is an option. That's fine.
Right.
But what I'm telling you is we're almost 100 basis points lower on average 30-year fix from last year. That is going to mean demand is going to be a lot higher this year because affordability has improved.
Yep.
Right? When you are down a whole percentage point on $1 million more or less home,
makes a huge difference.
Makes a big difference in cash flow. So that brings, what does that do? That increases the buyer pool, thereby increasing demand. So you will start to notice, oh, shoot, spring's here, and why is there so many competing offers?
Yes.
So if you'd like to get ahead of it, you have about 6 weeks.
2 minutes.
So I'm just letting you know what you're up against, and it's a good thing. But there's also unintended consequences to that good thing. It's going to be you're like in a lot more competition.
Right.
Yeah.
We've already started to see it.
Yeah.
Already, like, bam, it's like January 1st, and like my phone on the weekends is like, I have a referral for you. I have a referral for you. So I'm already feeling.
Activity's already through the roof.
Activity is great.
So we have 25 applications in as of the end of the day yesterday and 2 business days this week.
Right.
We'll be at probably 50 applications by the end of this week as a group. Our best week last year during the heart of spring busy season was 30 applications.
Amazing.
So like this is obviously heading in a certain direction. Just get ahead of it.
Yep.
All right. I am super grateful, Ashley, that you made the drive for Ventura. You battled the 405 freeway. All right, we're going to wrap it up. Thank you, everybody.
Thank you.
Happy New Year. Hope you learned something.